Good morning. My name is Steve Sefton. I'm the president of Endeavor Bank, and you have been invited to and are in our very first webinar of our Business Owners Forums. And what Business Owner Forums are for Endeavor Bank is an industry panelist group, which you see the three on your right, that are here to provide expert information based on the topic that we've chosen. And today's topic is the insurance industry with a focus on homeowners insurance, but also taking in the broader industry of commercial insurance. And our panelists will break that open in a minute. And the reason we are doing a webinar and not in person, because all of our prior business owner forums have been in person, is because of urgency. And the urgency is all about the fires in LA and the San Gabriel Valley. We thought that the information that our panelists could provide would be more urgent for you to hear, as opposed to all the time it takes to put on an in-person meeting. So we are doing a webinar this time. With that, I'm going to turn over the mic to my co-host, which is Kathy Gonzalez, who's going to provide some instructions and introduce our panelists. Kathy, take it away.
Thank you, Steve, and welcome again to everyone joining us today. Here are a few quick housekeeping items. This session is being recorded and will be available for replay. We will email you a copy of this presentation following the end of our meeting. To keep things clear, all attendees will remain muted during the panelist presentations, and all video connections have been turned off. If you have any questions, and we hope that you certainly do, please look at the bottom of your screen and you'll see a Q&A box. You want to click on that and it'll open up a panel so you can type in your questions. Remember, if you have a question you want directed to a particular panelist, just notate that panelist's name in the question and we'll be sure to direct it to that panelist. Also, at the end of all three presenters, all three panelists, we will be having a Q&A session. So keep those questions coming. If you experience any issues, any technical issues, try refreshing your Zoom. If that doesn't work, you may need to go out and come back in. Sometimes that helps. Each panelist is going to be speaking for approximately 10 minutes or so. And again, we will have a Q&A session at the very end. But remember, those questions are going to be coming out of that Q&A box. Also, stay tuned for more. Additional events are certainly in the works, and we will be sharing them with you in the near future. So check your inbox. Now let's introduce our expert panelists. Let's start with Peter Katkoff, is the founder and CEO of Apex Risk and Insurance. And next, we have Eric Motzenbacher. Eric is the founder and principal of Pacific Premier Insurance. And Joshua Morey will be our third panelist today, and he is the president of J. Morey Company. Now let's get to our panelist presentations. Peter Katkoff will be our first, and Apex is a brokerage focused on mitigating risks of privately held companies. Peter, you have the mic.
Thank you very much, Kathy. And thank you to Endeavor for organizing this event. Thank you to my fellow panelists for their valuable insight and our collaboration. And most importantly, thank you to the audience for taking time out of your busy day to learn about the often misunderstood yet critical world of insurance. While it is not always the sexiest of topics, I will admit, insurance does play a critical role in everything that we do. It protects your hard-earned corporate and personal balance sheet, as well as most households' single largest asset. Yet it is often dealt with reactively and not proactively. And the bankers on this call are acutely aware of circumstances where insurance can be the final unexpected hurdle in navigating a loan or escrow closure. And we never want to be the reason that a loan does not close. And today, with the panelists' help, we're going to try to explore how we can begin to reverse that trend. So as Kathy mentioned, I'm Peter Katkov. I'm the founder of Apex Risk and Insurance Services. Interestingly enough, I started Apex after 16 years in this crazy industry in San Diego to try to bring a consultative approach to my clients' insurance needs, much like Endeavor does from a banking perspective. I am a self-confessed insurance nerd, and I love finding solutions to previously unsolvable problems or seemingly unsolvable problems. Now, at my agency, we are insurance generalists. Kathy, you can go to the next slide. But we have clients across a very broad spectrum of industry, from life science to technology companies, commercial real estate, construction, hospitality, startups to stabilize and beyond. I will admit, however, that my agency focuses exclusively on commercial insurance. We do not play in the homeowners insurance sandbox. That being said, the macroeconomic pressures currently affecting the insurance industry don't necessarily discriminate between commercial lines and homeowners lines of coverage. So I will gladly defer to my fellow panelists on specific questions about whether or not State Farm is going to be canceling your coverage in Rancho Santa Fe or in Malibu. That said, I am a homeowner myself, and unfortunately, I've experienced firsthand the squeeze of cancellations and constant rate increases, even though you would think I would have more tools than most to navigate this complex situation. So I'd like to begin with a quick analogy to kind of set the stage. I think it's important that everyone on the call understands that insurance companies, with a couple of exceptions, the California Fair Plan, which we'll talk about, and the State Compensation Insurance Fund for Work Comp in California, these companies are for-profit enterprises. And like all of your businesses, the carriers have pressures to remain profitable, to grow market share, and ultimately to deliver returns to their shareholders. And Eric's going to go a little more into detail, but there are some long-standing legislative and bureaucratic forces that often make profitability difficult for insurers in California. But don't get me wrong, with record profitability across the board, I don't ever feel bad for the insurance carriers. They do not have my sympathy. They historically do two things very well. They collect premium and they deny claims. But it is our job as brokers and as the stewards of our clients' risk management programs to be our clients' advocates in these situations and help them as these pressures continue to mount. So here's a rhetorical question for Steve. If Endeavor Bank's prime lending rate was 4%, but you were legally bound to only be able to charge 2% interest on loans, would you still make that loan?
Never.
Clearly, the answer is no. And insurance companies similarly are being forced to operate at a loss ratio of over 100%, which means they often collect less premium than they are paying in claims. Or they're faced with the choice to stop offering coverage altogether for certain categories of risks. And these companies' actuaries have done the math, and they have concluded that it is not worth the exposure to their balance sheet, to their shareholders, to continue offering coverage for the highest risk assets. Now, it's important to make a unique distinction between businesses and home insurance. And that is, a business, when they see a significant increase in the cost of doing business, they can eventually pass that cost through to their customers through pricing. But as a homeowner, you can't exactly do the same thing. You can't charge your kids rent to offset your insurance increases. So this situation has a lot of homeowners, especially those on fixed or limited incomes, wondering if a solution is on the horizon. So to close, I thought it might be helpful to explain also what reinsurance is and how it directly impacts pricing. So insurance carriers use reinsurance much like you use your own primary insurance on business or on homeowners. So for a given property, the insurance company may only cover a small percentage, maybe 20%, for example, of that property's total insurable value. And then they purchase reinsurance to cover the remaining 80%, which does two things. It fixes their costs, and it ultimately hedges against the risk of a total loss. And in our rapidly changing world, with record-breaking losses from wildfires in California and in Hawaii, ice storms in Texas, hurricanes on the Gulf and East Coasts. Reinsurers, who are typically offshore and less regulated than our domestic carriers, have taken a significant portion of these catastrophic losses. And as a result, reinsurance costs have risen by more than 50% in the last 4 or 5 years. And ultimately, reinsurers pass these costs directly down to the insurance carriers. And as Josh will discuss later, those carriers then pass those costs directly down to you, the policyholder, whenever possible. Now, all of that being said, I am cautiously optimistic about the future. While many carriers have been forced to leave the state due to these profitability issues that I've mentioned, I believe that over time, both legislative reform and free market forces will encourage competition. This should eventually lead to more stable pricing and ultimately the availability of coverage. It is critical that you, as the policyholder on both homeowners and commercial, partner with brokers who are not only informed and have their finger on the pulse of the situation, but are also proactive and communicative and ultimately committed to helping their clients navigate this dynamic environment so you can ultimately get the best outcomes for you and your household and for your business. With that, I would like to remind you again that we'll be taking questions at the end of the presentation. So click the Q&A box and throw your hat in the ring, and I will send it back to Kathy.
Peter, I'm going to jump in and ask a question if I can. So as a banker, we're looking at financial statements all the time. And when we look at financial statements, it's a look back. It's historic. And I'm not talking about projections and looking forward. We do that too. But looking backwards, I'm looking at 22, 23, and partial year 24. The year-end statements are just starting to show up. But I'm seeing these insurance costs skyrocket, both for owner-operated commercial businesses and for real estate projects on LLCs and such. Do I understand that we are hopeful that that's going to stabilize, or has that happened? Is that starting to happen yet?
Again, thank you for the question, Steve. Again, optimistically, we are seeing a leveling off of commercial property and casualty rates in California. Now, the damage has already been done, and some clients of ours have seen 50 to sometimes 100% increases over a 4 or 5 year period that absolutely affects profitability and often loan covenant ratios, as you're aware. So I think that we are slowing from a rate increase perspective. And again, the free market economy will ultimately drive competition back into the state. We're seeing new carriers come in with new product offerings and new AI-driven underwriting engines that make them more comfortable with individually underwriting a specific location as opposed to from a 30,000-foot level.
Thank you, Peter. Kathy.
Wonderful. Thank you, Peter. And again, I just want to remind everyone to please look at that Q&A box at the bottom of your screen. Click it, opens up. If you've got a question and you're thinking, I shouldn't ask it, please ask it. There is no wrong question to ask. These panelists are here for us to be able to glean as much information out of them as we possibly can during this time. So please ask away. Now we're going to move to Eric Motzenbacher. Eric specializes in personal lines, which include fire insurance for your home. Eric, you have the mic.
Well, thanks for having me. I'm Eric Motzenbacher. I've been the principal for 16 years and currently serve on the board of Independent Insurance Agents and Brokers of California. I'm here to discuss navigating California's tricky insurance market, particularly in high fire risk areas. A little background on me. Before I started with Farmers Insurance, I originally started with Farmers Insurance and went on to found Pacific Premier Insurance, specializing in finding and managing coverage for both residential and commercial real estate owners. We love insuring everything from homes and autos to real estate, rental properties, apartments, commercial buildings, HOAs, construction project, and investment portfolios. Uh, I grew up in Lake Tahoe, California, and have done a lot of business up there since 2009. So I like to say I've been dealing with high fire risk insurance since before it was cool. It just so happens that most of California is deemed somewhat high fire risk today. And I'm happy to dive into Prop 103, the California Fair Plan, cost benefit analysis of CapEx on apartment buildings and where I think this is headed. But for the sake of time, I really want to focus on a few real stories that I've seen that really articulate how to navigate this market. But please feel free to drop any questions that you have into the chat, like Kathy said, so that we can get to Q&A at some point during this webinar. So just a really quick summary. How did we get here? Rising inflation, changing weather, California's complex regulations have all played a significant role. And if we could click to the next slide, actually, this slide highlights the California Fair Plan and their concentration of risk in certain areas, which is a big reason why many insurance companies are pulling back from the state. The end result of factors like these are driving up costs, causing cancellations, and making it harder to find good insurance options. And that was all before the fires in Los Angeles. As a result of the fires in Los Angeles, the California Fair Plan has just issued a $1 billion assessment because those fires exceeded its reserves. So what can you do is the question. And I've got a list of actionable tips that you can apply. So rule number one, understand what is driving your insurance rates. And I'll give you an example. So last year, we were invited to meet with a homeowners association in San Diego. Their insurance had been previously $160,000 a year. And right before Christmas, they received their only renewal offer of $2.5 million per year. So the board had an impossible decision to make. Do we let the homeowners association go uninsured, which means that no one can finance on the purchase of a unit within this HOA, or do we issue a special assessment to all our members to cover just 3 months of coverage while we search for alternatives? What was the solution? Well, we got the call and met with the committee. We reviewed options, and ultimately the board decided to rewrite the CC&Rs and reduce the HOA's coverage. It basically allowed unit owners to purchase individual policies with building coverage. And that was fortunate that they were able to do that. It basically took the air out of the balloon and saved the HOA from bankruptcy. So really understanding what is the main driver of your particular insurance costs is a big deal here in this market. Rule number two, know your insurance company's appetites. So we had a client referred to us last month. The realtor and buyer were about to fall out of escrow on a commercial building in Northern California because the client was unable to find insurance. And by the way, they were working with a large national agency, but property is really tricky right now. So what was the solution? It wasn't anything magical in this situation. It was just knowing where to look and muscle memory. We ended up finding the client an affordable option in 1 day, and they closed on time. And that was just, again, knowing what your carrier appetites are, and that paid off for everybody. Rule number three, don't believe all the rumors. There are a lot of rumors out there right now. There's a lot of noise being made. I would say 4 to 5 times per week, someone tells me that they were told their only option is the California Fair Plan. And that's almost never true. It might be true that their agency that they're working with only knows to check the Fair Plan, or that's the only one they have access to, but that's not really a full picture. I've even seen offices recommending the California Fair Plan when reconstruction of the residential property or the commercial property far exceeds the cap the Fair Plan has in place. So for example, a home that needs $6 million to be rebuilt, being insured for only $3 million. And what I don't think people understand is that the California Fair Plan has a co-insurance penalty in place, meaning if you don't insure the property to value, not only do you not have full coverage in the event of a full loss, but you might not have coverage in the event of a smaller loss, say a $1 million loss in that example. might only get paid out at 50% because it was only insured 50% of value, less deductible too. So I think without a doubt, there's a large number of Californians who are very uninsured and may not even be aware of how small an event could cause a very significant financial loss. The moral of the story for here is don't believe the hype, don't believe the rumors, talk to someone in the know. So that last example, I think, articulated a pitfall within the California FAIR Plan with regards to coinsurance. So rule number 4 is make sure you have the right coverage for the right situation. Policy exclusions are nothing new in the insurance market, but companies are tightening up on underwriting and how they handle claims. So I met with someone who was involved in ADU construction recently, and they told me about a time they took a $150,000 loss because they didn't have the right policy in place for construction. So communication with your agency or your insurance company is so important right now to help avoid exclusions and making sure that you have the right coverage in place. Rule number 5 is build a relationship with your underwriter. Just like in relationship banking, underwriters play an important role in this process. So last year we had a client who was buying a new apartment building. We gathered all the necessary information and reached out to our underwriter. The risk wasn't quite what they want, but we provided so much information to offset their concerns that they decided to approve. It was great news. Unfortunately, the client, they trusted us, but they were curious about getting other options and quotes. So they had reached out to another agency. That other agency had submitted to the same company. And because they didn't provide all the supporting documentation, the carrier declined the risk. And because of that, our underwriter had no choice but to decline our quote, which they would have approved. So it ended up costing the client, and we had to wait to resubmit. The moral of the story here is work with a relationship office, someone who knows and specializes in your industry and understands what you're doing. It can make a really big difference. And then rule number 6, work with an agency that has options. So just one more anecdote for how challenging this current insurance market is. We work with a lot of captive insurance companies, and captive offices are, the big box name brand companies that have agencies on every corner, so to speak. Historically, if they couldn't write something, they might reach out to us and we'd help assist in getting that placed. Lately, we've seen an increase in those referrals because it's harder for them to write business in this market. But the agency reached out to us in this situation because they were moving their office from this side of the street to this side of the street. And obviously it was insured by them for them. But in this case, they weren't allowed to rewrite their insurance just across the street, and they were asking us to rewrite their insurance for their own office. So, I've been in the business 16 years. I've never seen anything like that. Talk about no exceptions, but that's where we are at. So these are some of the very common, unfortunately common situations and phone calls that we're handling daily in this market. We've successfully navigated them. There is no silver bullet. There are proactive steps that you can take to position yourself ahead of your peers. But knowing an agency, a knowledgeable agency, and working with them can make a significant difference in preparing for what lies ahead in California and the broader insurance market. And with that, I will send it back to you, Kathy.
Thank you very much, Eric.
Hold on, Kathy. I'm going to ask Eric to jump in and ask him a question.
I knew you would.
Eric, you're being a gentleman and not naming names. When you say captive, you're talking about State Farm, Farmers, those kind of people?
That's an example, yeah.
Okay. And so what I think I heard is that because this market has become so extraordinarily difficult, that having a relationship with an independent broker that has many options, many different solutions, this is the time where you want to develop that relationship as opposed to being with one single captive.
Yeah, I think so. I think the state of the market and where we're heading bodes really well for the future of independence. I think that we have admitted options, we have non-admitted options, and we have options for the California FAIR Plan. So if you're in the position where you're thinking, hey, I want to make sure that I'm getting a competitive bid on this, I think we are definitely the place to be looking.
So one more question. So you mentioned $1 billion in assessments from the California FAIR Plan. In my mind, that only means that if I'm on the FAIR Plan, or if I'm going to have to look at the FAIR Plan, that my portion of that $1 billion assessment is coming to me and I'm going to pay that. Is that what I heard?
Yeah, so of that $1 billion, 97% is going to be allocated to personal lines insurance companies, and 3% will go to commercial. And then it's based on market share from 2 years ago, 2023. So we'll just use the company State Farm because they're one of the largest. They had 19.7% of the market share in 2023. Of that 970 million, that's going to get divided up among their policyholders, and it has to be listed as a separate line item, and it's supposed to be collected from State Farm within 35 days. It's going to be really interesting to see how this all plays out in the coming months.
So if I'm with State Farm and they're getting a big, what I think you said, 17% of a $1 billion bill, I can expect that to be crammed down to me, because I think you mentioned that they just got some special rate increase ability.
They're asking for an emergency rate increase. Whether or not so interesting. This is how the Department of Insurance has it worded, but it's actually not encoded in law anywhere that this can happen. So I would expect that the legal challenges will be significant and will be coming fast and furious. They're actually trying to get legislation passed right now. They're trying to get someone to carry a bill to codify this into law. But go figure, no one wants to actually carry that bill forward and say you can pass your insurance costs for not, onto consumers. So, this is all touch and go.
Wow. All right, Kathy, we'll come back to some more questions later. And again, reminding everyone, move your cursor to the bottom of the screen and there's a Q&A button down there.
I love the question, Steve. Now, last but certainly not least is Joshua Mori. Joshua has extensive experience in both commercial and personal insurance, particularly in high-risk regions. So can't wait to hear from you, Joshua. Take it away.
Thank you, Kathy. And I'm just grateful to be here today because really with Endeavor Bank being a community business bank and our business, I'm a third generation business owner in our community, and so community means everything. And we have offices throughout California and Hawaii. So when I talk about rebuilding and what insurance looks like post catastrophe, we have real examples from even a couple months ago here in LA, but even before that in Maui with our office in Maui a year and a half ago with the Lahaina fires. And I just want to touch on community being so important. And I love that we're doing this webinar with community business owners and homeowners and also professionals in their fields, because if we look back a year and a half ago at the Lahaina fires, you had all the big corporations coming in and giving their help. But where we sit today, where are the big corporations? And it really is the local community contractors, the local banks, the local insurance agencies, and then the community leaders that are now leading that charge of rebuilding Lahaina. And I imagine that in LA, we'll see the same thing. There's a lot of big corporates coming out of state, coming in, helping right now. But a year and a half from now, what is it going to look like? So love being here. Grateful to be here. And I'm going to touch a little bit about what does the road look like ahead? So this is a road that it just looks so straight. We know exactly where we're going. We can see the destination. And Peter touched on it earlier, where if we just open up the free market, I think a lot of our problems would be solved so easily. Seems like a simple fix. We know where we're going. We know how to fix it. But it really does get complicated. A couple stats before I go into some of the complications is, we think that in California, and I'll touch on homeowners insurance, for example, we think that homeowners insurance is expensive. But when in reality, Oklahoma is the most expensive state to purchase homeowners insurance in the nation. For a $100,000 replacement cost in Oklahoma, the average price is $7,012. Well, here in California, for the same coverage, it's $1,772. So just kind of setting the stage a little bit that we may feel like we're overpaying here in California, and it's very expensive. When across the nation, Oklahoma is 4 times more expensive than California for the same homeowners policy. So that sets the stage a little bit. There's reasons why insurance companies in California have left and are continuing to leave, and that we don't have this open market competition. Slide 2. So here's the reality. It seems like we still know where we're going. We can see down the road there where we want to go. But look at this road. It's crazy. There's so many twists and turns to get to the same destination. It's going to take so much longer to get there and seems very, very inefficient. Um, so if you're an insurance company in California, up until last year, if you wanted to file for a rate increase, you had to use historical risk models for that filing. And what that meant was that you couldn't use these forward-looking models. You just had to use your previous experience. And so a lot of companies, they wouldn't even file for a rate increase because it's anything above 6.9% would then be sent to a hearing. And then a lot of those hearings, you don't get the rate approval above 6.9% for 3.5 to 5 years. And so how do you know what's going to happen in 3.5 to 5 years when you're filing for your rate today using historical risk models? It just, as a business owner, and insurance companies are business owners, it seems like you can't predict anything into the future. So it's impossible for the insurance companies to do business in the current environment. Regulations are a huge reason why there's so many twists and turns along this path to where we know where we need to go with opening up competition in the marketplace. There's 160 bills on the docket right now in legislation. 10 of those are focused solely on insurance. I'm going to talk very briefly on 2 of them that I think are going to help. Number 1 is called the California Safe Homes Act. And what this does, it allows discounts to the consumer for fireproofing your property. And it will really, so even an insurance company has to file for these discounts. This bill would allow these discounts to be pushed through very quickly. So it's a good thing. Number 2 is the Fair Plan Stability Act. And this allows for the fair plan, as Eric was mentioning earlier. It is overexposed, it is underfunded. And one of the reasons why is because the fair plan can't purchase catastrophe bonds. Like any other insurance company if they have cat exposure, would purchase catastrophe bonds to finance their exposure. Well, because of legislation, they haven't been able to do this. And with this Fair Plan Stability Act, they will now be allowed to. So it's a very good thing, but is also the reason why, and the problem we've even gotten here is because the Fair Plan, until this point, hopefully the bill gets passed, couldn't even purchase a catastrophe bond to finance the risk. So at the end of the day, a competitive marketplace is where we need to go. This winding road is going to take a while to get through, but we'll get through it. Last year, the insurance commissioner, Ricardo Lara, put together a sustainable insurance strategy. Now, there's depends what newspapers you read or news outlets you read. This seems amazing, right? Like finally in California, we're going to have a strategy to solve our insurance problem. Well, as you looked at the last picture, more regulations, more legislation actually makes the road even more windy. And so, as good as this may sound, I think in a lot of ways it will help, but maybe even in more ways will create more turns and a harder environment for our insurance industry. Let me give 2 examples. In the past, you could not pass through your reinsurance costs as an insurance carrier in your rate filings. And you couldn't use forward-looking risk models. Up until last year, the bills were passed that now insurance companies could do that. Eric touched on that a little bit talking beforehand, so I won't get too deep into that. But I mean, it's a little dumbfounding to me that for 49 out of 50 states have had this in place for years. And so finally now, as of last year, we're saying, okay, this groundbreaking California Sustainable Insurance strategy is going to allow for these 2 aspects of rate filings. Well, we're the last to the game. And we can talk about how amazing this new strategy is going to be, but realistically, we're just catching up. for these pass-through reinsurance costs and these forward-looking risk models, there are strings attached. So if what we've been using State Farm for the example, if they want to utilize that 50% increase in their reinsurance costs and pass it on to consumers, well, then what State Farm has to do is they have to increase their exposure in high risk areas to 85% of market share. So take 20 home insurance policies, for example. If State Farm had 10 of them in high risk areas, they now have to get to 17 in the year or the years to follow. So yes, you can use these, but you have to increase to 85%. There's all these strings attached. So it gets incredibly complicated. But I don't want to just talk about the doom and gloom of the industry. Technology is changing so fast. I was at a InsurTech conference 3 weeks ago in Las Vegas, and there's this unbelievable technology coming out. So next slide, please. Yeah. And what I would say is you need to own your own future. You cannot control legislation. You can't control regulations. You can't control which insurance companies are leaving the state or coming in, but you can control your business. You can control your household, and you can control your community. But as I was talking about the InsurTech conference, without you knowing, there's aerial imagery that's being taken right now, and it's not just Google Maps. It's aerial imagery, and it's very, very high tech. But what they're doing is they're using that aerial imagery, combining it with data that is public available data on permitting for your roof, permitting for your electrical, plumbing, whatever it is. And they're giving you an individual risk score. And for your business, they're giving you the score. For your household, they're giving you a score. So these rates and this imagery isn't been adopted fully in California yet, but it's coming soon. And so with that coming, you can make your business and your household a higher score, which then makes it more insurable and at a lower cost. And non-admitted carriers, we've been talking about the admitted market a lot, are coming into the state. So one of the questions that I ask, or I get a lot is, well, if I fireproof my home, can I get a decrease in my premium? Will it become more insurable? Well, there are non-admitted carriers coming in, and their pricing in a lot of ways are cheaper than the admitted carriers. But with that, you need to get this designation or certification called the Wildfire Prepared Home Designation. And so there's things that you can do now in preparation for the next 6 months, the next year, the next couple years, or even 5 years down the road. I'm going to close with, my dad said, never waste a crisis. And I truly do believe that our insurance industry is in a crisis. But I think in a lot of ways, if we embrace this crisis, we can make our homes more resilient, our communities more resilient. And I know there's a lot of business owners on this webinar to make our businesses more resilient. And for the business owners in the webinar, if you haven't gone through an ERM or an enterprise risk management exercise, I would encourage you to find a good broker or a consultant to do this for you. Identify across your whole business what are the biggest risks. And maybe it is wildfire, or maybe it is that ports get shut down and you can't receive your goods. But whatever it is, use this as an opportunity to make your business better, make it more resilient, and then create business continuity plans around those highest risks to your business. So own your future, build better, and build more resilience. Thank you.
Well, Joshua, that's a lot. How about if I jump in and ask about that risk score? So we have a family friend that was a founder of Altadena, and their family, homestead is right in the middle of it, and plenty of houses were burned down all around them, but they fireproofed their home, and it didn't burn. So should I be proactive and just hire, find an industry expert and hire a contractor and do that? Or should I wait to hear from my insurance company?
No, I would proactively start to do those things. If you're waiting to hear from your insurance company, it's already too late. And the whole thing about business continuity for your household and your business, you want to prepare for these things and be proactive before they happen. So in that example you just gave, that home survived, but what if the 3 blocks around it, all those homes in that community were doing the same thing? And then so that that whole community survives. And very quickly with technology, maybe you can insure that whole community at a certain price, and there will be insurance company that will take it on. And so it's start with yourself, but then your community matters as well. And that resiliency can pay off, I guess, financially in the years to come.
Great, thank you. So we're now in the Q&A section of our webinar, and I see that the questions are starting to line up. That's a good thing. And a reminder, go take your cursor down to that bottom stripe at the bottom of your screen, and there's a Q&A box. Just click on that. And I'm going to start with Bill Perkins' question. He lives in next to a park with a large open field of combustible material. Is his homeowner policy at risk of getting canceled? I think I know the answer to that.
Yes.
Thank you, Eric. I forgot to say Eric. Go for that one.
Yeah, I mean, he could be at risk for being non-renewed. I wouldn't have it keep me up at night. If he does get a non-renewal letter, just reach out as soon as you get it. And there are other options out there. I think there's a little bit of hysteria. I get this letter and the world's ending. There are other options.
Thank you. Jonathan Ingram asks, we need to focus on being proactive rather than reactive to address key issues in California, such as ISO ratings for impacted regions and the challenges in maintaining fuel modifications and setbacks. These factors significantly contribute to current rate problems. As I observed during my 8 years as a regional conservation authority chairman and multiple species habitat chairman, which one of you wants to take that question? And I'm not sure it's a question. Anyone want to speak to that?
One thing that jumps out there is maintaining fuel, because I think this really would make a tremendous difference in California. A lot of land in California is federally controlled, and I think we did pass in years before a lot of funding to manage this better. But one of the things one challenge that we run into, just taking that one little snippet there, controlled burns, you run into issues with liability where they could accidentally start a fire and be sued as a result. You run into wildlife concerns, starting a fire and then having wildlife injured, and then the aesthetic issues of just people don't like the way it looks when you go through and do these things. So just that it is interesting. There are a lot of solutions, and there are also challenges with each one of those solutions. And I just think more thought like this is what we need to keep moving forward.
Great. Thank you, Eric. And if you have a follow-up question based on the answer, go ahead and type that in too. I'm going to throw this one to Peter. Ryan Yates is asking, we often work with businesses undergoing major changes, new locations, acquisitions, equipment upgrades. What are the key insurance considerations during times of growth or transition, given all the issues you talked about?
That's a good question, Ryan. And Joshua did speak to it briefly, but there is never a bad time to do a comprehensive review of your existing insurance program. And operational changes are no exception to that. If you are adding equipment, changing locations, changing your product offering, acquiring materials from a different country or elsewhere, all of those operational changes can have insurance implications. And we find far more often than I'd like to see, insurance programs just remain static over time as a business changes significantly, even through major changes like COVID, and readdressing and re-looking at the way that the insurance program was originally set up is crucial to making sure that it is now set up to accommodate your existing situation. And we generally try to, it's hard to look in the crystal ball sometimes, but looking beyond the headlights and understanding what is not only the status quo today, but what may be coming down the pipeline from an operational perspective to make sure not only the current coverage can accommodate it, but that the carrier is okay with those changes. Maybe if you were selling one particular product and you pivoted into a different industry, that coverage may no longer apply to that specific product. So it's important to stay in touch with your broker and make sure that they understand if you make those changes, how to address them.
You know, Peter, I'm going to follow up because you triggered a thought. I hear over and over and over again, business owners waiting for their renewal date. And then they don't get their renewal quote until it crams up into the renewal date. And then they believe they've missed their opportunity to get a competing quote. Did I hear you say that business owners shouldn't be tied into a specific renewal date and can have a broker look at their business anytime?
Sure. So you can always reevaluate the existing coverage. Now, that's not necessarily to say that the cadence of those annual renewals have to change because of those operational changes. We are ultimately tied to the carrier's timelines, and we begin our pre-underwriting process typically 120 days before those policies renew. The carrier will not talk to us about an upcoming renewal prior to 90 days. So that 90-day trigger is when we typically try to have all of the operational and functional updates to the carrier 3 months ahead of the renewal. But just because the renewal is 9 months away doesn't mean you can't make changes to the existing coverage by endorsement or otherwise. And I think it's also important to note that when a business owner or a homeowner gets these notices of cancellation, these non-renewal notices, not to sit idly on those letters. So they typically will come 60 days before the carrier pulls the rug out from under you. And we as brokers need every one of those 60 days in this challenging market to get the best outcomes. If you pick up that letter 20 days before and make a couple phone calls, not only are brokers underwater with work, but so are underwriters. And if we give an underwriter a challenging submission with limited information 2 weeks before the renewal, it is going to be very difficult to get the best outcome.
That's helpful, Peter. Thank you. I'm going to throw this one to Joshua from Lucy Busby. How can we educate our clients on what the insurance process looks like in this current market? Timeline, underwriting process, service expectations, just preparing them for what's coming.
There's some good resources that we can send out after the webinar. And I know Eric being on the board of IAB Cal, there are some resources. Outside of just some of the resources that you can click and send, I think having a list of brokers or agents that are very knowledgeable that can, you can have it on a sheet of paper or you can have a conversation. I think a conversation is always better to give a true outlook of what the industry and the process will look like.
Great. I think, Joshua, I think you were talking about the scoring system, so I'll follow up with this one to you again. This is from P. Linson. Let's get more info on the score system. Who's putting this together? Is this like a credit scoring? We had an insurance inspection and then the insurance company would not give me a copy so I could see what I needed to improve. They just increased the insurance by over 120%.
Yeah, so the insurance company is probably using that scoring from the aerial imagery. I think Peter probably has a real example of this, but like the imagery can be taken at a certain point and given a certain score, and then you're going to get a notice from your insurance company saying, "Here's pictures that we have taken, and you have 15 days or 30 days to respond." And with that, you get up on your roof and scrub off some of the moss, or trim some of the trees back, send the pictures back in. But I think the point here being is to be able to control your household in this instant where you don't have overhanging trees. You do have defensible space. And so that when those pictures are taken of your property, you are already given a high score, and then really taking ownership of the maintenance of that score. So it is very similar to a credit score. Um, it hasn't been approved again where like, a FICO credit score. It is just proprietary knowledge that's being given to these insurance carriers. But it will become, I think there's 10 departments of insurance in the nation that have adopted the scoring already. It will get to California at some point.
So this one's from Steve Claro. I happen to know where he lives up against the foothills in the San Gabriel Valley. So his question is very appropriate in terms of recent events. Hi, my question is better to currently is better to currently is it better to currently self-insure and wait for the markets to stabilize than reinsure when it has stabilized? Additionally, if I were to self-insure, would the lapse in coverage add risk to getting a policy in the future? Second question, I would like some clarity with fire and liability. I think liability is more important at this minute, and I would like your input on just having liability, or if it's not worth it, and if it's fire and liability coverage or no coverage. So that's a lot. So Eric, why don't you jump on that one?
Yeah, thanks, Steve. And Steve, that's a fantastic question. I guess I have a follow-up question. I guess it depends on what he's referring to with self-insuring. If he means just going bare without any property coverage, that's one thing.
I think that's what he's talking about. And Steve,
Yeah.
you can clarify with another question if it's not.
Yeah, and I mean, look, we get the question about like joining a self-insured captive on occasion. I mean, I think the challenge with property in particular, if you were going to go that route, is just when you do the feasibility study and when you look at actually how much it costs to fund it and how the claims would pay out, they just really don't. It doesn't make sense to go that direction. But I think it's a good exercise for people to go through because it gives a little bit of like appreciation for what the insurance companies, the risks they're taking on. I do have clients, I have some wealthier clients who have opted to just go bare without insurance on their homes and they'll eat the cost if something happens. And in that case, we are just putting up, liability coverage to make sure that they're protected for that situation. But I would say that's rare, and I would say that would be deployed for very, specific people that can take that kind of a loss and keep moving. I think most Americans that is, like Pete said, it's the greatest asset people own, and so I wouldn't recommend that as a first choice.
Yeah. And can I add to that real quick? In Hawaii, the hurricane is excluded, right? And so they have actually Hawaii is the cheapest homeowners rates in the nation, but it's because hurricane is excluded. I think sometime down the road here, wildfire or windstorm may be excluded in California. When we see people that are not buying hurricane insurance in Hawaii, it's because they have had the upgrades to their home where they feel comfortable around it. So I wouldn't just say, I'm going to save $15,000 or $20,000 by not buying property insurance this year. I would say, I'm going to use that $15,000 or $20,000 to harden my home to make sure that over this next 5-year period, I'm going to invest $75,000 to $100,000, and I feel with confidence I don't need insurance because I've hardened my home in a certain way.
So I'm going to follow up, Eric. If Steve were to go without insurance, yikes, it just disappeared. If Steve were to go without insurance, when he went back to the market in the future, say a year or two from now, is that going to affect his coverage because he's been absent?
Probably, yeah. I missed that part. I did read that when it popped up. So thank you for reiterating that, Steve. Yes. I think when we go back out to market and we show a lapse in coverage, it's kind of it's like moral hazard. Like the insurance company or the underwriter is looking at that, going, well, why did they allow that to happen? Do they value insurance? Are they proactive? Are they proactive as a homeowner? Are they doing the right things that we want to see as a client? So they are taking that into consideration. And I'd actually expound on that too. I mean, the part when they fall into that gap, sometimes what happens is the bank force places insurance coverage. And that gets into a really kind of tricky situation right now too, where in some instances, bank force-placed insurance coverage is less expensive than what the market is, which probably just has some catching up to do in and of itself, but it adds another layer of dynamic to this question.
So this is to the panel, and all three of you can speak to this in turn. Why don't we start in the order that you spoke, if you care to do it that way, Peter? This is from Jose. Can you provide websites where I can obtain more information on what I can do before I receive a notice of a huge rate increase or cancellation?
Thank you, Jose. Yeah, I think we are going to share some resources, IIBA Cal specifically, in the notes following the presentation. And they have links to a ton of resources for homeowners, for business owners, what to do to prepare for potential catastrophe, and then ultimately what to do thereafter. So we'll certainly share as much as we can.
Eric, did you have a comment on that one?
I don't have much to add. I think Pete said it all. I think then the other resources are what to do in the event of a catastrophe or a fire. I think we have lots of information on that, especially in the wake of Los Angeles.
Okay, we'll be adding those resources to our follow-up, Eric.
Absolutely, yeah.
Josh, do you want to add anything to that?
No.
Oh, could I add one thing? I guess just like I guess maybe less for homeowners insurance and more for commercial on like the apartment building side. We have this conversation a lot with clients about trying to be best in class. What does it mean to be best in class, and making these capex, paying for upgrading electric panels and upgrading roofs and stuff like that. I mean, that's really the decisions that you need to weigh. And unfortunately, there's not like there's not like a white paper necessarily to help you make that decision. I really think it's a conversation that you need to have with your agent to kind of navigate what's the right thing to do for your specific situation.
So, Josh, this question's for you. This is from Ryan. You mentioned the California Insurance Commissioner, and as Ryan understands, this is an elected position. Beyond engaging with the elected insurance commissioner directly, what actions can business owners and individuals and consumers and advocacy groups take to influence insurance policy reforms that benefit both consumers and businesses? So what's your recommendation to this audience for advocacy?
I would say the state assembly is probably the best place to start, and they may respond to you. So find your local state assembly member, and reach out to them and find out, are they engaged or involved with any of these insurance reform bills? And then you can also give your opinion there. It goes a long way. Secondly, depending, say you're in the real estate industry, I would find a political action committee that is focused on insurance, so that you do kind of have a seat at the table and skin in the game to influence those, the policymakers.
Great, thank you. I think we're coming up on the last question here. With insurance costs increasing, what are the panelists' thoughts on increasing the deductibility to help offset monthly premiums? I can answer that one. Any one of you can jump on that.
The math equation where you slide deductible up and hope premiums come down doesn't always net a significant decrease in costs. I mean, if you're insuring, 10 or $15 million worth of assets, to change your deductible from 5,000 to 15,000 doesn't really change the bulk of the exposure to the insurance company, right? They know that you're probably not going to file a $7,000 claim, and changing that deductible, sliding that scale up, generally has a very nominal increase or decrease in the premiums. And also, you may have loan covenants or lease agreements that preclude you from self-insuring the first portion of that loss. Say you wanted to increase it to 250,000. So you may be contractually bound to keep that deductible low. So it's not always the solution that many people think it might be.
Great information, Peter. I appreciate that. Christy Powell put in the chat box, the Q&A box, some information that we might want to get out there in our resource filing when we do that after the webinar. But in closing, I wanted to say just one thing in closing that I say often when I'm out and about visiting business owners, and this is what I say outside of the current panel, even though it's promoting them. I think a good insurance broker, which I call a risk consultant, is the least used resource by owner-managed businesses. Too often, I think I see owner-managed business owners refer to their controller or their CFO to just come back with a lower rate quote. I think that business owners should be meeting with the people that are in this panel or whoever your independent commercial insurance broker is, and having them being a trusted advisor on all things business. They're out there visiting with a lot of different business owners, and they're picking up a lot of great information that's not just in their insurance footprint, but in today's world, certainly in the risk avoidance footprint. But I think business owners are not tapping this resource as well as they should. Finally, we're going to close with each panelist giving us a takeaway. So Peter, shoot.
Thank you, Steve. So yeah, my takeaway is ultimately not to accept the status quo, right? Carriers are taking advantage of the policyholders, and brokers are ultimately overwhelmed and lazy. So that's why policies stay static for a long time, and they're not always motivated to find the best option for you. So my suggestion is to push for the best outcome. And to Josh's point, I did have experience with my large national carrier sending me a non-renewal notice because I had moss on my roof. Exactly the situation that you explained. And I took matters into my own hands, and I did get up on my roof, and I took pictures of that immaculate roof, and I sent it back to my agent and demanded that they reverse that non-renewal. So you have more power than you think you might. You just have to take matters in your own hands sometimes and get them to do what they don't want to do.
Did you win?
Of course.
All Pete does is win. Mine is the change unfolding holds big opportunities for those who are prepared and adaptable and have the right mindset. And I just think that's always the case.
Yeah, and my closing is own your own future and build resilience. The first question I think that was asked was around a proactive approach, and owning your future takes proactivity, and the crisis is now pushing all of us into thinking creatively and to really building something that'll last. So own your own future and build resilience.
You're on mute, Steve.
Kathy, am I forgetting anything? I feel like there's a message I was supposed to deliver.
We are going to be emailing out a copy of this presentation directly after, and we will also, you can see that the individual presenters have their information if you want to reach out and get more information from them. And I believe we will also be sending out a resource of some of the websites and some of the other information. We'll be sending out a follow-up. And stay tuned for more opportunities to learn with Endeavor Bank. Back to you, Steve.
So I just want to say good afternoon. Thank you to our panelists. Thank you to Wendy and Amber, who helped put this together, as did Ryan Yates. So we appreciate all the hard work for our internal team. And thank you to our panelists for participating. And to all our clients and friends, keep your eye out for our next Business Owner Forum that's coming up in the near future. And we look forward to seeing you there. Thank you.
Thanks for having us.
Have a great day.
Thanks, everyone.
Thank you.